Good evening, everyone. My name is Sherman. I'll be your host for this evening. All right. So before we start, let me share a couple of house rules for this session. First of all microphones will be muted upon entry. Secondly, headset is recommended for better optimized sound quality. And should you have any questions, just feel free to type into the chat box and we shall address them later in the Q&A sessions. All right. So once again, welcome everyone to us in this very beautiful evening, whereby this is actually a fireside chat. So when it comes to this fireside chat, right, that simply means it will be you will be able to treat it as a very casual sessions to post any questions that you like, anything that you would like to know more about our FSMOne Managed Portfolios. All right. Now, our FSMOne Managed Portfolios is an all-in-one solution of online investment advisory services that builds, monitors, and balances your portfolio for you. With us, right, your money is taken care of by professionals. In this very particular webinar, or we call it fireside chat, all right, we will be sharing with you what are the strategies that we adopted to keep the volatility of the portfolio at a relatively low levels while ensuring that you are investing profitably. All right. These sessions is meant to be a very interactive sessions, all right, with beginners and also for both beginners and also seasoned investors looking for places to invest their money and enjoy the freedom of your own time. Okay. Now, everyone, before we start, right, please stay with us throughout the whole sessions, right? And after our fireside chats, right, in this evening, we will be announcing a very good news for all of you today. Now, first of all, joining us today will be Mr. Jerry Lee Chiong, the portfolio manager of FSMOne Malaysia. Besides managing the IFAs and also FSMOne Managed Portfolios, he is also managing the private mandates portfolios for our high-level clients. Prior to this, he was a treasury dealer at Affin Hwang Asset Management, dealing in foreign exchange trades and money market instruments. Jerry also graduated from Tunku Abdul Rahman University College with first-class honor. And of course, Jerry is also a CFA charter holder. So first of all, let us welcome Jerry to join our fireside chat today. Hi,
Hello,
Jerry.
Sherman. Hi, Sherman. Can you hear my sound?
Yes, crystal clear.
Yeah. All right. Okay. Thank you. Thanks, Sherman, for the kind introductions. Yeah, I think we should start our fireside chat session today.
Yeah, sure. So I think since this is actually a fireside chat, we wanted to keep it more casual, less formal. Even today, both of us, we gel our hair. You are wearing your coat. I'm wearing my formal shirt in this Friday evening. But treat it as a casual sessions. Relax, sit back, and answer questions from our audiences. And to all of you in this room today, in this evening, because we wanted to be more interactive. So just give me a one or a yes in this chat room to let us know that you are with us in this beautiful evening. All right. So I think yes, all right, we are seeing a lot more answers, a lot more responses from our participants. Thank you. That was beautiful. All right.
Yeah, so we see a lot of response here.
Yes, let's go. Okay. So I think first of all, Jerry, would you be able to introduce us to a bit on what is actually a portfolio management services? Who is actually FSMOne Managed Portfolios? Jerry?
All right. Okay. So I think just now, Sherman, you also touched a little bit on what is the managed portfolio, or we call it the portfolio management service. It's an all-in-one kind of investment service that we provide to all of our investors. But let me talk about it. If you look at FSMOne's, few years back, we are calling ourselves actually FSMOne. And when we first started in Malaysia, right, in the year of 2008, we first started as a fund distribution platforms, and mainly selling funds. But along the way, we started to realize that in order to help our investor to invest globally and profitably, which is our mission, if we just stop as unit trust funds, it's not enough. So over the years, we started to onboard a lot more investment products. We have bonds, we have managed portfolio that we have introduced in the year of 2017. And I think recently, we have just launched our stock and ETF platform this year. So I think also in the few years back, we have just rebranded ourselves, call it FSMOne, a one-stop solution platform. And I think if you look at the idea of this managed portfolio, or we call it the portfolio management services, right? It's because over the years in Malaysia, we started to realize that in the industry, we have more than 500 to 600 kind of different type of unit trust funds. And a lot of our investors, they are the DIY investors. They have their full-time jobs. They got their own jobs to do, and probably investment is just their part-time jobs. They look at it after their works, and it's rather difficult for investors to really understand a fund's inside out. And it's rather difficult to ask investors to really study a markets and know where to buy, which funds to buy, which area should I put it in. So, and along the way, so we started to think about it. Since over the years, we have been receiving a lot of questions from investors, where to buy, which funds to buy. Why not we come up with this portfolio management service to help an investor to construct their portfolio, and we manage the portfolio for them. Over the time, if we think that it's necessary to do some rebalancing, to do some changes to the portfolio, we will actually do it for the investor, and it's still free of charge. There's no switching cost. There's no additional sales charge when we do changes for the investor. So basically, the idea is actually to help our investor to have a more hands-off approach when it comes to managing their wealth over a long period of time. And throughout these portfolio management services, we actually also aim to deliver a more consistent returns for our investor. It won't be a portfolio that purely invested or concentrated with a specific area where it costs investor couldn't sleep at night. It is a portfolio that you can sleep well at night. Do not need to worry about what happened to your investment if today, what happened to Evergrande. We all heard about it. But having said that, all this kind of incident, black swan event happened over the years, over the past 2 to 3 years. Our portfolio managed to consistently deliver a very consistent return to our investors. So the idea is really to bring on a hands-off approach to our investor. They do not need to think about what to buy and when should I buy, when should I sell, all these kind of questions.
I see. So if I understand you correctly, it is actually a portfolio where FSMOne will help me to manage. Am I right?
Yep, you're right.
So within the investment vehicles, like what are the compositions of the portfolios? So is it pure unit trust funds?
Yes, at this point in time, we purely leveraging on unit trust fund. I think we have some plan upcoming. We are going to include a little bit of ETF, but it's not in the near term, probably early next year or second quarter of next year. We are going to include a little bit of ETF into the portfolio. So right now, at this point in time, it's purely on unit trust.
I see. So if I imagine it correctly, it's actually a portfolio of funds right now. And then in the future, you're going to try to bring in a little bit exposure into ETFs, right? Now, when I talk about ETFs, I'm just curious, what are the ETFs regions that you'll be looking at? Is it from Malaysia or is it from other countries? What is your plan actually?
Yeah, it's a very good question. If you think about it, right, we know that in the markets, we have different kinds of products. Some of it, we call it the robo-advisor and so on. They mainly, if you look at some of these products out there, they are leveraging purely on ETF. One thing that people because lower cost. But from our point of view, cost is one thing that we need to take care of it also. But if you look at the investment universe, the global equity markets, right, not all the markets, not all ETF are actually goods to invest in, especially for some of the inefficient markets. For example, if you look at Malaysia equity markets, if you take a very good example, Malaysia equity markets, if you purely invest into CI, which we call it the FBMKL CI, composite index, if you purely invest into CI, I think over the past 10 years, you have made not much returns, probably a low single-digit returns. So these are the markets, these are some of the inefficient markets that we should avoid ETF. And we should leverage on the actively managed unit trust fund. The fund managers will be able to pick stock that could outperform the index. So if we're going to bring on unit trust into the portfolio, I think some of the markets that we are looking at to include ETF, probably US equity markets, European equity, and also Japanese equity. These are the efficient markets where we think some of the unit trust fund, we're still able to see some funds to outperform the benchmark. But the outperformance is not significant. The alpha is not significant. So in that sense, probably is slightly better if you use if you leverage on ETF.
I see. So you are trying to say, apart from having exposure within unit trust, you will try to add some ETFs by next year. Then eventually it's I think the way you differentiate yourself with other robo advisors in town is where people are, the other robo advisors are doing pure ETFs, but within FSMOne is actually a mixture between UT and ETF with an emphasis within UT, right? Am I right?
Yeah, because we still see a lot of the markets that we're investing in, especially in Asian country, particularly China or even Malaysia equity. These are the markets that we still see a very significant alpha to be delivered by the fund managers. So we still see a chance of all these actively managed unit trust fund to outperform the index itself.
But you only mentioned when it comes to ETFs, you will only pick all those like developed markets like US, European, and also Japanese markets. What about the other sectors like sectorial? We found out that recently, because when I'm looking into my own portfolio or when I comes to into the news flow, I did a little bit study on all those global apps, CNBC apps. Recently, there are a lot of people has brought up topics like EV, clean energy. Would you try to to include something ETFs? Some ETF like this in the future?
Yes, possible, because if you look at in terms of unit trust space, there is also something that we lack of, especially in Malaysia. We don't really have some of the sectorial funds. So that's why, like you mentioned, if you look at Chinese equity markets this year itself, it has been very, very volatile. But if you look into their small to mid cap companies, if you look into their, for example, the green energy sector, the green technology sector is actually performing quite well. So some of the specific sectors that we will actually leverage on the ETF is provided that we don't have such a funds within the unit trust space. And we think that in these particular sectors, it's rather difficult for the fund managers to outperform the index. Then there will be a chance that we will go for the ETF.
I see. Because when I'm glancing through the Q&A questions, right, actually some of our audiences has actually asked the same questions like I did. Like we are comparing with other robo advisors. What are the advantages? And also the other robo advisors has also introduced thematic portfolios which invest into technology adoption, digital consumptions, all these clean energies. So I think just now from your answer, you managed to tell us like what are your plans into the next year already. Okay. I think other than that, so by far, I can somehow imagine that this is a portfolio where it's very suitable for people like me, who is like 24 hours working with my screen, with my in the office. I prefer to let someone to help me to manage my investment capital. Am I right to say that?
Yeah. I think the main objective is really to provide a more hands-off approach to all our investors, because we know that all our investors, they are coming from different field, and perhaps a lot of them, they have their own job or their own full-time job. So not everyone will be able to have times to do their own analysis, to do their own study in terms of how to actually allocate and how to actually manage their investment. So this idea of the DPMN is more to actually provide a hazard-free investment approach to all our investors. Sherman, are you still there? I think Sherman's lines is down. Take some questions from the floor to see what are the questions that our investors are asking. Okay, I see the questions here asking about do you rebalance the managed portfolio? So I think in terms of portfolio rebalancing, we don't, most of the time, I think a lot of people have the perception that, for a lot of the portfolio, they do have a periodic rebalancing mechanism. For example, every quarters, every half a year, or every year, I will rebalance one time our portfolio. But for us, when it comes to managing a portfolio, we don't set a periodic rebalancing mechanism. In fact, we do it when we think that it is necessary to do the rebalancing. Because, for example, if you look at it, my portfolio is doing very well over a year period. All the funds are performing, and there's no need of rebalancing. Why should I do a rebalancing for my portfolio for the sake of doing? So for us, we do it when it is necessary. But over the years, you will start to notice that we will rebalance our portfolio when there is a sharp movement in terms of markets performance. For example, in the year of 2020, what happened in March 2020, we see a significant sell-off in the global equity markets. The global equity market as a whole dropped close to about 30+%. Now, at that point in time, we think that the fundamentals could be affected because of the the COVID-19 pandemic. But at that point in time, we're seeing plenty of liquidity being injected by the global central bank, and we see a lot of supportive from the global governments. So that's why we think that the sell-off is a little bit overdone. What we have did is that we actually rebalance our portfolio and increase back our equity allocation. So portfolio rebalancing for us is not on a periodic basis, but we will only do it when we see the price have moved significantly on one direction without a significant move in terms of the fundamentals. So those are the period where we actually start to rebalance our portfolio. And Sherman,
okay. Yes, Jerry, I'm back. Yeah. I'm back to this fireside chat. I'm so sorry about it because my internet connection was not very stable. Looks like I need to invest more to get a better Wi-Fi already. I might be the first host from someone that dropped out from this fireside chat. Okay, I think so just now I have already understand more about when it comes to this portfolio. It is actually suitable for people who prefer a more hands-off approach. Am I right to say that? So, yep. But I just want to know more about, because constructing a portfolio, probably for me, right, it could be quite tedious, could be quite complicated. Would it be able to share with me and also share with us what is the methodology of your portfolio and how do you construct and also manage the portfolio over the years? Would it be able to share us more?
Yeah, no problem, sure. But in order to explain a little bit in terms of the methodology, right, probably I will need to share my screen. I think just a few slides, just to share with everyone in terms of our methodology and how we actually construct the portfolio and manage the portfolio for our clients. Before that, Sherman, can you see my screen here?
Yep, all good. Please keep it layman for me.
Yeah, no problem. Okay, so I think to keep things short, right, for the for interest of time, I won't go into very details, but basically, if you think about it, when it comes to managing a portfolio, I believe most of the time when investors pick their own investment, when they pick up funds to buy, the first thing that we will look at, for example, Sherman, what are the things that we will look at when you want to decide to buy a fund?
Probably, I think, depending on what kind of risk preference do I have. If I'm used to fixed deposits, then probably I want to go to be more conservative. But for me, my portfolios are 100% all into Malaysia stocks, then probably I will want something more interesting, attractive for me.
Yeah, I think, the thing is probably you're still looking at risk, you're still matching your risk profile. But a lot of the investors, right, after being in the markets for so many years, we start to realize that a lot of the investors, right, the only thing, not to say only thing, but the key things that they are looking at is actually on returns, the performance. So it becomes something very common within investors, retail investors, that returns is the only factors that I will consider when I decide which fund to buy. For example, last year was a very good year for tech, was a very good year for China equity. So we have a lot of the investors start to buy into tech early this year, before the significant drawdown in the month of February, March. And a lot of the investors start to buy more into Chinese equity. So it becomes like, returns become the only factors that investors will consider. But for us, when it comes to managing a portfolio, we don't just looking at returns. It's also very important to consider the risk that you are taking for the portfolio. For every single risk that you are taking, is it worth for us to take the risk? So these are the things that we will consider. And if you look at the sentence here, what we try to achieve is actually to maximize the risk-adjusted return through long-term value investing. So you can see, we see ourselves very much of fundamentals, value investors. We focus very much on fundamentals. And when it comes to construct our portfolio, right, I put it very simple. Basically, there are just three steps, 1, 2, 3, inter-asset allocations, intra-asset allocation, and fund selection. So the first step here, right, we need to decide, we look at your risk profile. Are you a balanced investor or are you an aggressive investor? If you're a balanced investor, you will have half into fixed income and equity. But if you're aggressive, you will have more into equity and less into fixed income. That's fair enough. We look at your risk profile. Beside your risk profile, we also evaluate the current macro environment, the valuation of different asset class to see where should we put more of our capital into those particular asset class. For example, at this point in time, if we think that the situation is much clearer, the prospect is much clearer, the macro environment is more positive, and valuation for equity is actually slightly attractive. So this is a period where we will put more into equity because we expect equity to outperform the fixed income over a longer horizon. So these are
meaning, Jerry, when you say that when the market is doing better or the outlook or you predict it to be, I mean that it will do better, the portfolio will help us to adjust more into equities. Is that what you mean?
Yep, you're right. So what you
do
is actually to select your own risk profile when you first started. Now, if you are a balanced investor, you just buy into the balanced portfolio. So balanced portfolio on a neutral allocation, it will be 50 in equity and 50 in fixed income, right? But at the time where we think the equity outlook is much attractive, equity have a higher chance to outperform the fixed income. That's where we will actually start to increase your equity allocation in your portfolio. This is something that will be done automatically.
I see.
Then if we move on to the second step, right? After knowing your risk profile, everything, allocating into 2 different asset class, then we need to go into like, within equity, where should we invest? We have so many markets, we have so many equity markets. We have US, Europe, Malaysia, Asia, EM. Where should we invest? So I won't go into details, go into all those technical things, but basically we benchmark our allocation to MSCI GDP weighted index. And from there, we will do our fundamental analysis for all those markets that are under our coverage. We look at the earnings prospect, we look at the valuation for the respective market and see which are the markets that we should allocate more capital in. So these are the things that we will do within the intra-asset allocation. Which market particularly, US, Europe, Malaysia, China, which are the markets that we need to invest in. And after knowing the second step, right, we know already I'm a balanced investor, 50-50 between equity and fixed income. I know already within equity, I need to invest 10% in US, 20% in Europe. Within fixed income, I invest into Malaysia and maybe Asian bond. So like we go into the third step, also the final step, So I've decided all those allocation, but which funds should I buy? We have 600 over funds, 500 to 600 funds on our platform. Which are the funds that should we put into our portfolio? So in this step or in this process, we will screen through all the funds based on 2 factors. First is quantitative. Second one is qualitative. Quantitative are all those, your performance, your expense ratio, your volatility, the downside risk, the maximum drawdown. These are the quantitative. It can be measured, But what is more important to us, right, is the qualitative factors. Qualitative factors is the one that we think it could actually help us to generate more alpha. Why do I say so? Think about it, right? In the past, what you are looking at quantitative, right? They are all the historical data. These are something that happened in the past. So when you look at the funds, well, it delivered 100% in the past 1 year. But the next question is you need to ask, what caused the funds to have these 100% returns? And is it consistently over the years, it can deliver a very decent returns? And you need to think about the team that managing the funds. Do we have a change in fund manager? Let's say if you have a fund that managed by a star fund manager, in the past 5 years, it's consistently delivered a very decent return. But in the year of 2021, the fund manager has left this fund house to another fund house. So what happened is that all the historical data that you are looking at no longer makes sense to you. It's no longer a valid data for you to analyze the performance, the quantitative factors of the funds. So for us, right, what is more important is really all those qualitative factors. So these are basically the 3 steps, how we actually manage our portfolio for all our clients.
I see. So you mentioned about 3 simple steps, like you will decide how many into equities, into fixed income or bonds, number 1. Number 2, then you will see which country that you like the most, which sector that you like more. Then after you know where are the ideas that you like, how to allocate, then you will pick, can I say winners within the funds? Within the portfolios. Now, I took a quick glance on your portfolio fact sheets. Okay, there are about 15 to 17 funds. Would you find it too many funds? Because for me, if I'm I would say a beginner, I would say like too many words, too many funds. I do not know what are you buying. So would you think that you are overly diversified yourself? Like you're like probably too. I mean, because what I learned was if you are over diversified, means you don't have conviction in the markets. What is your comment on this? Just curious.
Yeah, okay. I think this is a very common questions that we usually get from a lot of the investors. They're commenting that you have more than 14, 15 funds in your portfolio. Yeah, I don't really understand all the portfolio. So you need to know, right? That's the beauty to the investor. You do not really need to know exactly where are they investing, because we have a team to manage for you to look at all those funds. But back to your questions that will it be overly diversified? Our answer is no, because you think about it, right? We need to have funds that invest into the developed markets. And the reason why we don't just use a developed market funds to replace US, Europe, and Japan is because that we want to have our decision to say, because if you're investing into the global funds, right, developed market funds, right, the decision is actually up to the fund managers to decide where are they want to put the capital. Do they want to put more into US, Europe, or do they want to put more into Japanese equity? So we want to have the core, because we are doing asset allocation. So that's why you will see within our developed market space, we have a single country US equity fund. We have a single country European equity fund, and we have a single country Japanese equity fund. Actually, we can actually lump everything up to put the global equity funds, but we don't want to do so because we have a view on all this market and we want to express our view. That's why we have all those single country equity funds to let us express our view within when we're doing the asset allocation. So
eventually, when you're doing this, right, at the end of the day, that means that does it mean that you have more control on the portfolio?
Yes, you can say so. We are using a global equity funds. You're actually leaving all the control to the fund managers to manage the exposure within US, Europe, and Japanese equity. If you're looking at developed market space. Yeah.
All right. So in fact, for me as an investor, be it 10 funds or be it 15 or 17 funds, I shouldn't be concerned, because what I do is I will rely on your team's expertise to help me to filter the funds, do all the analysis, do all the research. All I do is just managing your your performance that I question you. Am I right to say so?
Actually, you can just see our portfolio as a global equity fund. You just can compare our portfolio with a normal global equity fund, because if you think about it, at the end of the day, like I mentioned, a lot of investor question is why do we put so many funds in the portfolio, and investor level, they don't really understand each of these funds. So they always ask like, how to understand all the 15 funds. But you need to think about it. You are not, the idea of investing into the DPMS, a managed portfolio, is to pass all the burden to us. Let us manage for you. So that's why you no need to understand all this funds, and we are here to help you to manage your global exposure, your funds with the global exposure.
I see. So FSMOne, being as a platform of unit trust funds and also other products, so I would have able to imagine that you would have a lot of good connection with the fund houses. So when you wanted to get first-hand information, does FSMOne has all this edge or advantage compared to us, like a normal retail client?
Yeah, I think that's exactly the point that I wanted to point out within the qualitative factors area. So qualitative factors such as, for example, the fund manager strategy, whether they are holding more cash or they are holding they're fully invested at that point, and also whether there's a significant change in terms of the investment team. These are the very important factors for us to evaluate the funds. Let me give you a very good example. In the year of last year, 2020 March, we have did one change to our portfolio for the Islamic portfolio. We actually removed the BNB Global Arab, if I'm not mistaken, BNB Arabesque Global Dividend Fund back in during the sell-off back in March 2020. And the reason why we removed the fund is because we realized that at one point the fund actually hold about 70% in cash of their exposure in cash. Meaning to say that they only invested 30% of the fund's value.
Are they allowed to do so? They can do so.
Yeah, because the mandate allow them to do so. And in fact, there are funds that are running on momentum strategies on quants. So we know during any significant sell-off, any black swan event, right? These are the funds that will actually start to sell their exposure and hold cash. But back in March, I mentioned earlier on, we actually favor equity markets back in March. So we actually increased our equity allocation. Then we realized this fund, it hold about 70% in cash. But for us, it doesn't make sense because if I invest into the funds and the funds have 70% in cash, I actually have not much exposure in the global equity markets. So we actually removed the fund and we included another funds. If you just purely compare both of them based on historical performance, BNB fund is a much better fund if you're looking at just purely looking at performance. But because we are analyzing them from a different perspective, on the qualitative factors perspective, so we will be able to make a more informed decision from this perspective. So these are some of the information that we will be able to get, before some of the retail investors.
I see. So you have mixed up your point when it comes to how do you construct a portfolio, how do you manage it, what are the factors that you look at when it comes to managing a portfolio. Would you be able to show us, I think, the most important data that we all wanted to see? How great are you? Would you be able to share us your performance over the years to convince everyone of us?
Yeah, I also saw a lot of questions on the chat box regarding the
performance figures.
Yeah, let me screen through, see if I have my performance figures. Yeah. So over here you can see this is a performance table for our portfolio. If you look at cumulative level, year to date up to 31st of August, we have conventional and also Islamic portfolio. So up to 31st of August, our aggressive portfolio actually delivered about 8.4% this year. Despite the volatility in the Chinese equity market, despite the volatility in the Asian equity markets, we managed to deliver 8.4% on a year-to-date basis for aggressive portfolio and about 5% for a balanced portfolio. So if you look at annualized return, 2 years annualized return about 17.2, and 3 years annualized return is about 10.5%, because we know that last year was really a very good year for the global equity markets. And towards the right hand side here, you can also see the calendar year's performance. I think 2020 and 2019 was a very good year for our portfolios. But 2018, everyone knows that it was a bad year for the global equity markets, and our portfolio also took a hit, down about 11.3%. That's why the 3 years annualized return was affected, and we see a 10.5% on a 3 years annualized basis. So these are the annualized return on a 3 years basis, meaning to say that if you look at it consistently over the 3 years period, we deliver about 10.5%.
I see. But I realized your 2017 return was somehow average compared to the market, because I remember 2017 was a pretty good year. What is the reason that caused your 2017 to be about average?
Yeah, okay. If you look at our conventional portfolio, right, because we started the portfolio in the middle of the year. So we started on 26th of May 2017. If you look at here, our since inception data is actually, we actually started this portfolio on 26th of May 2017. So that's why the 2017 data is actually from 26 May 2017 up to end of 2017.
Only half year
only half a year. And if you're able to recall correctly, for the year of 2017, most of the global markets returns was delivered in the first half of the year. So in the second half, we start to see markets start to moderate, start to stabilize a bit before the drawdown in the year of 2018.
I see. Okay. So throughout all these years, you're now shown us your so-called your performance record already, your winning ratio already. So I think would it be able to share with us, like because you are a portfolio manager, so I would expect you to help me to manage it, to help me to do rebalancing, or to help me to in and out funds. I switch in new funds or switch out old funds. Okay, how frequent do you do so? Because as a portfolio manager, I would expect you to be very hardworking in managing my portfolio. How hardworking are you? Would you be able to share with me?
Yeah, I think just now I've actually answered a little bit when your line dropped regarding the rebalancing, because I mentioned rebalancing, we don't do it on a periodic basis, but we do it when it is necessary. But regarding some of the portfolio changes, right, probably I have a few slides to share over here. I think I missed out the slide somewhere here, but yeah, I think it's not here. But it's okay. Just to share a little bit that this year itself, right, we have actually made some changes to our portfolio. For example, early this year, in the beginning of 2021, what we have did is that we actually cut our China equity exposure. We cut our technology exposure because we think that to a certain extent, the valuation for the global tech, the valuation for the Chinese equity is a little bit too stretched. So we started to cut our equity exposure from China, from the global technology, and we moved into European equity. We moved into emerging markets. So I think the European equity part is actually performed very well. I think European equity year to date, they are actually one of the best performing markets. And subsequently, in the month of, I'm actually looking at a conventional portfolio. I think in the months of April and March, what we have did is that we actually included one Asian technology funds into the portfolio. I think in that particular period, there is a time where we see a sell-off in a China tech perspective, but we don't have a pure China tech funds. So we invest into the China technology, one of the Asian technology funds from RHB. And also, I think what happened just recently, we have increased our equity exposure. So earlier on, before September this year, before this month, I mean in the months of for the first 8 months of this year, we are actually at 2.5% overweight in equity. You know, we overweighting equity by 2.5%. But in the month of September, early September, what we have did is that we increased our equity exposure from a 2.5% overweight to a 5% overweight. You know, we think that after the recent drawdown, especially in Asian and emerging markets, and also China equity, it's the right time for us to go into this market even more. So if you look at it just a little bit from the market perspective, if you look at Asian equity, emerging market equity, they are very much relying on the global trade activity. This year itself, we see a recovery year, but this economy, they do not really benefit from the global trade recovery because to a certain extent, if you look at some country like Malaysia, you look at some country like Indonesia, Thailand, they are still in another round of a lockdown few months back. But recently, what we are seeing is that a lot of these countries, their vaccination rate have improved significantly. And we expect the recovery will come through in the next few quarters. And they're actually standing at a much better positions to benefit from the global trade recovery. In fact, in the developed market, we are seeing most of the economy started to move from recovery stage to expansionary stage. So this will actually even provide a stronger catalyst to the Asian and emerging markets, which relying a lot on the global trade activities. So that's why we started to overweight our equity exposure. And the other thing that we have just did early this month is that because recently we just onboard China technology funds into our platform. Now, this is a fund that fit into the Hang Seng Tech Index. So with this fund coming into our platform, we actually decided to replace our Asian technology that we have included back in May, and we replace it with the China technology funds. So right now, we are actually overweighting the China tech at this point. I believe it is a very daring move. A lot of the investors are very concerned about the recent regulatory crackdown in China. And I see a lot of questions regarding how do we see about the recent crackdown on China tech. But what we think is that at this point in time, the valuation is very attractive. And we think that, yes, moving forward, earnings will be affected, but a lot of this negative impact has already priced in. So, and to a certain extent, it's already overdone. So what we think is that at this point in time, it's really, really a good opportunity for us to scope a lot more exposure into the China tech particularly.
So meaning that earlier this year, before the correction in China, and also the drama with Alibaba and Beijing, and also the correction, the adjustment with global technologies names happen, you managed to so-called reduce your exposure. Yep. That's number one. Yep. Okay. But and then right now, when China markets has been so attractive, so cheap right now, dropping every single day, then you manage to top up more. Am I right to say that?
Yeah, actually,
So right now,
we are cutting our fixed income exposure and moving more into the equity space at this point in time.
I see. So that explains why your portfolio is somehow, you can say that you are spared from the bloodbath in China in this year. Somehow a little bit.
Yeah, we are not fully spared from it. We are still having exposure in China. I think one of the things that we are doing for our portfolio is that we don't time the markets. It's very important not to time the markets, because you can get it right one time or two times, but you won't be able to consistently get it right if you are trying to time the market, right? Moving in and out from one market. So what we try to do is to actively manage the allocation, adding more exposure when it is cheap, reducing some exposure when it came to a very expensive level. So this is what we will do to our portfolio. We don't ever try to time and move out completely from a single market.
I see. So every time when you say you are overweighting, that doesn't mean all in. When you say underweighting, you are not like taking out completely from from the portfolio, right? Am I right?
Exactly.
So in this slide of yours, I saw your China is 10.5%. So that is the direct exposure. But
yep.
But if I count in the China exposure in Asia, Japan, and EM, my China should have more, right? Am I right to say that?
Yes, you're right. I think right now, if you take into consideration of the China tech as well, right? We have more than 20% of our total equity exposure in China.
I see. Okay. I'm right now I'm seeing within the group chat there is a lot of discussion within your performance figure. Would it be able to scroll back for us to take a look on the performance figure? I think sure. Some of our audiences has been discussing on the numbers of our portfolio returns. When it comes to annualized return, the 3-year 10.5%, does it mean that from 3 years, 3 years before until now, I only get 10.5, or that is the annualized or the yearly return? How do you? Okay. Yeah, would you be able to explain?
Yeah. Okay. So the 3-year annualized is actually an annualized return. So what we are looking at annualized returns, right? A simple means that every year you get 10.5%. But in fact, it's not every year 10.5. So you can see from the calendar year perspective, right? You on the 2018, we actually lost about 11. If you're looking at calendar year, 2018 we actually lost about 11.3%. But in 2019 and 2020, we managed to deliver about 18% each year in the year of 2019 and 2020. So if you look at it on average, every year you are getting about 10.5% over the past 3 years periods. This is the meanings of the 3 years annualized return. It's not on a cumulative basis. If you look at it on a cumulative basis, right, our since inception, since we have started the portfolio in the year of 2017, the total returns that we have delivered to our clients over the 4 years period is about 44.6%.
I see. So if I invest with your portfolio since day one, this will be my return, 44.6. Yep. 10.5 right. Is actually the annualized, which means that looking at the returns right now, if I somehow every year how much I would get, right? That's what you meant, right?
If you interpret in a layman manner, means that every year you get 10.5% over the past.
I see. That will be clear. So all these numbers are before fee or net of fee?
These are before fees, because
before fees lah.
If you're looking at our investors, right, a lot of them, they are a lot of the investors are because on and off we have some promotion, 0% sales charge and so on. So you will not be able to calculate the net of fees performance. So in fact, performance are before fees performance.
I see. Okay. So would you be able to share with us more like how your portfolio did after last year's pandemic? Because if you ask me, last year was a pretty good year for investors in the market, but not for those who are doing businesses and those who are working, definitely. How did your portfolio do? How resilient are you when market hits us hard?
Yeah, okay. So if you are looking at performance figure, of course, if you look at both Islamic and also conventional portfolios, right? You look at calendar year, you can see 2020 aggressive portfolio delivered about 18.1. Even the conservative portfolio delivered 7%. And if you're looking at Islamic, it ranging from 8.4 to 18.7%. So this is the return itself over the year of 2020. But I think what I can also show you over here, you can see the drawdown of the portfolio. So we're actually taking an aggressive portfolio to compare with the global equity markets. Because if you look at it, I can't take a balanced portfolio to compare against the global equity because global equity is full equity. So I need to take a most aggressive portfolio, which is our aggressive portfolio here, 90% in equity, 10% in bond. So what we can see here is that during the drawdown, we can see that our aggressive portfolio with 90% in equity, we had a much lesser drawdown compared to the global equity markets during the March sell-off. So we can see here the table at the bottom. The maximum drawdown in 2020 for our aggressive portfolio is only 24.5%. The global equity market is actually close to 30% in ringgit term. But what something to really take note is that after the sell-off, what happened after the sell-off during the global rebound, we actually did much better compared to the global equity markets. So if you look at the table at the bottom here, our aggressive portfolio delivered a so-called the post-COVID sell-off. We delivered a return of about 56.4% as compared to the global equity that did about 45.7%. Yeah, so I think these are contributed to some of the active strategy that we're implementing for the portfolio. Like I mentioned earlier on, in March, we actually increased our equity allocation. And subsequently, in the month of April, we also increased exposure to, we actually added technology into our portfolio. And for the 6-month period, our technology fund actually delivered about 100% to the portfolio itself. So if you look at it, we have about a 7-8% kind of exposure. So that particular fund itself contributed about 7 to 8% to the on the portfolio levels. So these are some of the active strategies that we will be implementing, and it is a strategy that able to add a lot of alphas to our investors.
I see. I think since right now, today, I'm a beginner, when it comes to investing, a $1 billion question is, how do I know when is the best time to invest? Because every time when I invest, right, at the end of the day, it will be the peak. So meaning whenever I start investing, that is the time when it comes to the next correction already. So as a portfolio manager, just share with me, how do you manage your own emotion? How do you manage your portfolio, especially where you see US market is all-time high, right? Every day when I open my news app, Apple all-time high, Alphabet all-time high. I wanted to invest, but subsequently after I invest, right, that doesn't seem to be true. Yeah. So what is your comment on this?
Yeah, I think this is this is really a $1 billion questions. Because you think about it, right? A lot of the time investors, they tend to think about, they tend to struggle and want to find the so-called best time to invest into the markets. But to be very frank to everyone of you, if you ask me, there's no such best time. On hindsight, we know, 2020 March was the best time to invest. On hindsight, everyone know it. But just think about it. Back in last year March, how many of us really dare to put in all our money into the investment? So there is no such thing called the best time to invest. In fact, I think from an investor point of view, what is really important to every one of us is that we need to know exactly what's our objective. What's your investment objective? How long do I plan to invest? If you are telling me that I just want to invest for a period of 2 months to 3 months, I don't think this is a right place, because investment, we know that over a short period of time, if you just have a few days to months time to invest, to a certain extent, it's not about investment. It's about you're putting your money at risk. You are gambling. You are betting. So you need to have a sufficient investment horizon. That's something very important. You need to know exactly your investment objective and manage your expectation. Right. We always tell our clients, when you're investing into aggressive portfolio, you can actually expect around 8 to 9% kind of annualized return over a 3 to 5 years horizon. But if you're telling me that I want to have a returns of 20 over to 30% a year, that seems like impossible. Probably in sometimes like you look at in the past 2 years, we're able to do 18%, but there's something beyond our expectation. It's a bonus to us. It's really a bonus to us. But a more realistic and more reasonable expectation is that we are expecting about 8-9% a year for an aggressive portfolio. So things that are very important is that you need to know your objective very well. You need to know your investment horizon very well and set the right expectation. Don't over expect some things that can give you a very, very good a very decent returns, and don't believe on certain products that promise you double digit or even 20-30 kind of percentage of returns. So these are some of the things that I think investors need to take notes. And to be very honest, there is no best time to invest. On hindsight, we know when is the best time. But if you're looking at this point in time, what is really important to you is to get to know what you want to achieve, and from there plan accordingly and invest according to your risk profile.
I see. Okay, so meaning that, so if I get your answers correctly, there will not be a best time or the worst time to invest. It's just that I need to be more patient. I need to set my expectations right. Am I right to say that?
Yeah, if you think about it, I think there's a famous quote, the investment world is a transfer of wealth. And the transfer of wealth is actually transferring from those are impatient to the patient investors. So this, if you know this very well, right, then you know that when it comes to investment, that's how should we do and what should we do when we want to invest our capital and want to grow our wealth.
I see. Okay, all right. So if that is the case, when would I be able to tell or able to know when should I increase the risk or reduce the risk that I'm taking?
Okay, I know this is a common mistake that a lot of investors will make, and why I call it a mistake is that your risk profile shouldn't be moving according to the market condition. Some people what they will do is that when market is good, they tend to be an aggressive investor. While market is good, I try to buy more, but most of the time they are buying at the peak. And when market drop, they tend to be panic and they start to don't know what to do, and they start to sell and tend to be a conservative investor. So their risk profile actually move according to the market cycle. This is not the right thing to do. I mentioned earlier on, you need to know your investment objective, your horizon, your risk profile accordingly, and from there you decide a so-called the right portfolio to invest in. So this is the right thing to do. It's not to change your risk profile based on the market situations.
I see. We have a question from Ho Xiang, from Mr. Lim, is where, with this current market situation, which is the best portfolio to choose?
Again, I think back to the answer that I gave just now. Don't choose the portfolio based on the market situation. Choose the portfolio that suit your risk profile.
I see. Okay. So with that in mind, right? Since I would like to know, besides you in the team, how big is the FSMOne team when it comes to managing the portfolio, and how does your team manage to add value for all of us, for investors that invest into the FSM managed portfolios?
Yeah, I think if you look at the portfolio itself, locally we have more than 6-7 analysts and portfolio managers here. But this portfolio itself, although it's actually managed by the local team in Malaysia, but if you think about it, our house view, our market views is actually on a regional basis. And regionally, we have more than 30 analysts, 30 analysts and portfolio managers in 5 different markets: in India, in Singapore, in Hong Kong, China, and also in Malaysia. So each of these analysts, they have their own respective country to cover. Some of them, they cover US, some of them, they cover Europe, Japan, and so on. And on a weekly basis, right, each of these analysts will be sharing their view on the respective markets to the team. And as a portfolio managers, what we need to do is actually, because to be very honest to you, we won't be able to know inside out on a single country because there's so many countries in the world. We need analysts to cover this country and share with us their view and so on. Then from there, we actually do our own analysis. So what we will do is actually we leverage on the view coming from the regional analysts from 5 countries, more than 30 of them. Then from there, we will actually do our own analysis. And in Malaysia, we also have our investment committee. So 4 of us in the investment committee, including one of the portfolio managers in Singapore that sit in our investment committee for Malaysia portfolio. So from there, we will actually discuss how do we actually make the investment decision for our portfolio. And I think one thing that I want to add on is that our portfolio is not managed by robo. It's not automated, everything. It's still very much relying on human to make the investment decision. In fact, we are still believing that to a certain extent, humans still able to perform much better, especially when it comes to reacting to a lot of the events, market events for example, all the Black Swan event. I think human is still better when it comes to reacting to all these unexpected events, and will be better in making a more informed decision. So that's why that's where we see the value that we could actually add on to a lot of the investors.
I see. So with that in mind, so just like you mentioned, you will do rebalancing, but you don't have a fixed schedule to do rebalancing. It is depending on how does the team sees the market, because it is not a robo trigger thing. It is in fact with human factor. Okay. So whenever there is a rebalancing that you're conducting, the investors will be informed. Would you be informing us like, oh guys, we are doing the rebalancing? Will you be informing us?
Yeah, we actually put up all the updates on a monthly basis, right, through our fact sheet to tell our investor that what happened to the portfolios, what are the changes that we make to the portfolios, and also our view on respective markets that we are investing in. Yeah.
Right. So when you're doing rebalancing, there will be, I imagine there will be a buy and sell already. So probably you want to bring in new funds, you want to kick out some old funds. All these charges would not be charged to me, right? Am I right?
No. Yeah, there's no additional charges to the investor, because if you think about it, if you want to align the interest between us and also the investor, we shouldn't charge investor. Otherwise, we can do rebalancing every month and charge investor. So that's not the right way to do it. Yeah, so that's why when we want to align the interest between investors and also us, we actually need to absorb some of this fee when it comes to rebalancing. So we will only do it when it is necessary.
So because when I used to buy some unit trust funds, trust funds, there will be management fee. So when I'm buying your portfolio, I will be paying you portfolio management fee. Am I paying double fee?
Yeah, of course. Because if you look at it, right, you are paying a management fee to the funds manager on the funds level. On FSM side, we also collect a management fee of 0.5%. So in fact, if you look at 0.5%, it depends how you look at it. You know, some people will say that I'm paying a double fees. But if you are paying a fees to a portfolio teams that help you to do your asset allocation, to allocate your capital accordingly, to select the right funds to buy, then I think that is an appropriate fees to pay for. You know, if the team able to deliver you additional alphas on top of what you're investing in, then I think that is something that worth to pay for. Yeah. So I think when we think about, because some people when they think about fees, they're always thinking that, you know, that's the reason why people, you know, in recent days people tend to invest into ETF. I think back to the questions, back to the answer that I have given. If in certain markets, if in certain areas that, you know, actively managed fund or actively managed portfolio could actually outperform ETF, why do we care about paying the additional 1% of fees? If the portfolio could deliver me 2% additional returns, why am I so care about paying the 0.5% of fees? So at the end of the day, what's important is really to see the value coming from the team.
So in fact, fund managers are doing their job to pick the winning stocks, and your job is to pick the winning fund managers of funds. Am I right to say that?
And also to do the proper asset allocation for our clients. So apart from picking the right funds, the right fund managers, we are also doing the asset allocation for our clients to see that where should we invest in? Where should we invest in? You know, US or Europe? At this point in time, US is too expensive. Should we invest into some other markets and so on?
I see. Okay. So when it comes to the expectation of investing into this portfolio, how long would you recommend me to hold on to this portfolio? Like short term wise, medium term, or long term? But and also when it comes to investing, right, everyone was telling me long term. But what is exactly long term means, and how long do I need to wait before I can see my returns?
Yeah, I think I don't talk about long, short, or medium. But I need to define a year, because a short term to a traders probably is 5 seconds or more, or 1 minute or 5 minutes, not sure, short term traders. But what we are looking at when you're investing into a fund of funds portfolio, when we are doing asset allocation, we are actually looking at a minimum of 3 to 5 years. Because we all know that, you know, in a particular years, right, there could be some Black Swan event that affect your portfolio performance. But over a longer horizon, you know, a reasonable investment horizon, that's where we will start to see value start to kick in. You know, they will see that, you know, the team will be able to add more value to your portfolio. So on a more reasonable basis, we are looking at a horizon of 3 to 5 years.
I see. I see. Okay. All right. So one more question is that today, if I'm a balanced portfolio investor, so balance for me means 50-50 into equities, which stocks and also bonds. But sometimes when I go through your fact sheets, my bonds is lesser than 50%. My equities could be go beyond 50%. So that is actually okay one, right?
Yeah, so that is because of the market's movement. So you will see in your fact sheet, you will see your target allocation and also your current allocation. So target allocation is something that we want to maintain for, and the current one is the fluctuation because of the prices due to the market movement. So what we will do is actually we will set a so-called a corridor of about 2 to 3%. If a certain asset class, the percentage move towards 3%, that's where we will start to trigger rebalancing. But it's very rare for this kind of asset class to move more than 3% unless we have some unexpected events, and that's where we will start to trigger rebalancing and rebalance the portfolios.
I see. Okay. All right. I think since right now it's already 9 o'clock, probably we will just go with it. We will just probably just take one or two last questions. So we can wrap up and also to finally announce our special promotion news, okay, to all of them. I think other than this, when you look into some of the charges, for example, the portfolio management fees, how do you charge me? Do you charge me annually or do you charge me quarterly?
Oh, the portfolio management fees is actually on a quarterly basis. It's actually accrual and actually we charge on a quarterly basis.
So meaning 1 year I will be charged for 4 times.
Yeah, we will charge 4 times, but effectively only 0.5% on a per annum basis.
I see. So it's 0.5 divided by 4. Then you collect for 4 times lah. I see. I see. Right. Okay. All right. So I think last but not least is ultimately is, if I were to make a very quick summary, is where this is actually a portfolio of funds, and in the future you might be adding in ETFs into your portfolio to so-called to capture the opportunities in other regions or sectors that might not be able to deliver by funds that we are having right now. Then apart from it, right, it is somehow different from the robo-advisors where there will be human intervention within, because you still believe that human will be able to add value. Then ultimately it's that there isn't any fixed schedule for rebalancing. Ultimately, it depends on how the market goes, what is the investment team's views towards the market, then you will trigger the rebalancing from time to time. Okay. Yeah. And somehow I think one of the very good important pointers that you make was, in fact, do not be too much. Do not be taking too or worry too much on the annual management fee, because in fact we are somehow getting a team for us to work. Somehow we hire you guys to work for us, to manage our portfolio for us. Okay. So I think, yeah. I think last but not least, I think we will just take one more market questions. For the next 6 to 12 months, do you think the market can do better, or market will start to go into a consolidation phase? What is your take? And I think recently, one thing is, I think everyone has heard of Evergrande from China. In Mandarin is Guangzhou Hengda. So what is their impact towards the markets? And would it cause another Lehman Brothers 2.0? And right now, if I wanted to invest, should I be concerned? Yeah.
Yeah, okay. Maybe we can just quickly wrap out some of the market views and also our strategy at this point in time. What I've shared just now, definitely at this point in time, we are seeing a much greater potential within the equity markets, but we are selective when it comes to investing into equity markets. At this point in time, we favor into Asian and emerging market particularly. We like China equity, particularly the China tech. I also see a lot of questions here regarding what's our view on the tech ETF in Hong Kong, what's our view on the China technology sectors, given the crackdown that have been going on for so many months. Are we seeing the light at the end of the tunnel? Are we seeing an end to this regulatory crackdown? So I just share a little bit of my view in terms of the China crackdown. At this point in time, we don't see that will be the end. I think it will likely to continue for a couple of months. But what we think is that if we think deeply about the intentions that the government want to achieve, the objective of the government, they don't really want to stop all these tech giants from growing. They don't really want to bash them down. The intention is really to promote a more sustainable, what we have been hearing in the past couple of months from the Chinese regulators and also the policy makers is that they want to achieve a more sustainable growth over a long period of time. If you look at it, what China have did in the past 10 years or 20 years, they want to grow very fast. So when I want to grow very fast, I wouldn't be able to bring everyone together and grow together with me. So what I will do is actually I build the top few and I grow together with them. So you start to see the income gap start to widen in China. And that's not a healthy sign, because if this gap continue to widen, there will be a lot of social issue coming up, and as a country, you wouldn't be able to grow sustainably. So this is what China want to tackle at this point in time. They want the country to grow sustainably. And we have heard about, common prosperity that being mentioned many, many times this year itself, if you all follow a lot of the Chinese, the event in China. So these are the key things that we need to focus on. We don't think that the intention of the government is really to stop them from growing, to bash them down, to stop them. Well, the intention is really to promote a more healthy growth. So from that perspective, we think that a lot of the earnings will be affected moving forward. But at this point in time, we are still looking at double-digit earnings growth for all the China tech in the next couple of years. And if you look at it, based on our analysis, the Hang Seng Tech Index, which is a China Technology Index, they are expected to deliver more than 50% kind of upside potential over the next 2 years. Yeah, so this is somehow our view and also our conviction within the China Tech, and it has also been reflected in our portfolio where we just added China Tech, and in fact we've increased our exposure to China Tech. We actually cut down our exposure from the global tech because in the developed market space, valuation have ran up too much. It's time for us to start to take some profit. So we are underweighting the global tech and we are overweighting on the China Tech perspective. So regarding your questions about Evergrande, people are mirroring Evergrande to Lehman Brothers. I think there are two different things. In fact, if you look at it, why do I say that they are different? In fact, if you look at the asset that they are holding, Lehman Brothers are holding financial asset back in 2008. Evergrande, they have all those physical assets. They have all their land bank. And one very important thing is that think about it. Both incidents happen in different countries. One in US, another one in China. Like it or not, we think that China government at one point they will actually step in, but we don't think that they will build them out. Because if they build them out, they send a very wrong message to all the property developers in China. If they build them out, it means that government are telling you that don't worry. If you want to take risks, you want to have high gearing, do it. But if you successful, all your shareholders benefit from it. If you fail, government help you. So these are the wrong message that the government they do not want to send out to all the different companies in China. So at this point, we don't think that the government will build them out. But what we have been seeing is that the management from Evergrande have been putting in efforts to get things solved. And at one point, if really they tried their best and they couldn't solve it, what we think is that the government will step in to help them out. And in fact, we have been seeing a lot of accommodative policy. We have been seeing a lot of liquidity being injected into the financial markets. So we have been seeing that the government actually have the ability and they have all the policy tools to really support the market. So we don't think it will be like Evergrande, like the Lehman Brothers in the years of back in 2007, 2008. Yeah. So overall, just to sum things up, at this point in time, we still think that it's good time for us to buy more into equity. That's the reason why early this month we added exposure to the global equity market, particularly Asian, China, and also emerging market. And for investors that if you have taken profit earlier on, I also think that this right now is actually a good time to invest. But do expect some volatility moving forward. We don't expect market to move up smoothly like what we have experienced in 2020. We don't expect those kind of double-digit returns in the year of 2020. Return expectation will start to moderate, will start to stabilize within a high single-digit level for aggressive portfolio. But still, we see a higher potential of equity markets to outperform the fixed income markets moving forward.
I see. Okay. So I think so far in this evening, we have somehow managed to answer close to 40 to 50 questions in the Q&A session. However, in the live chat, there is still a lot of questions going on. I think there are some questions that I think probably I might be able to answer again on behalf of Jerry. There are yes, our fact sheets are monthly available. Okay, eventually, whenever you want to see commentaries, what are the changes, performance figures, that will be all available within the fact sheets. And also, I think Jerry, just now earlier you mentioned that the timeline for you to include ETFs into the portfolio, when will be the timeline for next year?
I don't give any promise, but we are looking at probably second Q of next year.
Second quarter of next year.
Next year, yeah.
Early second quarter or late second quarter. That could be April or June.
Oh, really, I can't give any promise, but hopefully we are looking at the early of our second Q for next year.
I see.
Late first Q or early second Q of next year.
I see. Okay. Now, I think since we have come, we're almost coming to the end of our fireside chat in this evening. Finally, I will be able to, to announce the good news whereby to everyone, FSMOne Malaysia will be offering 0% subscription fee or sales charge for all conventional and also Islamic managed portfolios with subscription fee. So that simply means that this portfolio is this promotion is only valid from 25th of September, which is tomorrow, all the way until 15th October 2021. All right, when it is only valid for lump sum investment only. Okay, so one more time, 0% subscription fee for all conventional and also Islamic managed portfolios. Okay, now before we end this fireside chat, Jerry, do you have any last advice or comments to everyone around you in this evening? Anything you want to add on?
Yeah, I think maybe one last thing to add on is that we always hear people talk about it now, or even the famous value investor Warren Buffett talk about it. Be fearful when others are greedy, and be greedy while others are fearful. Now, I know it's easier said than done, but tend to do it. And because we know when it comes to investment, the evergreen strategy is buy low and sell high. And if you want to practice buy low and sell high, you need to be greedy when others are fearful. Not to say that you need to be very greedy, but at least you need to buy when others are fearful, because opportunity only comes out when there's a lot of volatility, there's a lot of uncertainty. And at this point in time, we really see that although we expect volatility is likely to continue over the next few months, what we see the downside risk is rather limited for certain markets. And at this point in time, given that the recovery trend in the global markets and also the improving vaccination rate, we think that global economy is likely to perform quite well over the years, 1 year or 2 years. Although there are some noises about supply disruption and so on, Fed hiking interest rate, but think about it, these are some of the noises will likely to affect the short-term market performance. But over a longer-term picture, what we are seeing is that we see a higher chance of equity continue to outperform. And if you are planning for your investment, tend to look beyond all the short-term noises. Like what happened in 2017, 2018, or even 2019, we have Donald Trump. But if you just focus on Donald Trump and China trade war, in that particular 2-3 years, you wouldn't invest into the equity market. But if you look back, 2017, 2018, or even 2019, equity market actually trend higher over a 3 years horizon. In fact, in between, we have some dip, we have some volatility. But if you look beyond those noises, what you will be benefit is to capture the long-term growth in the global economy. Yeah, so that's my last piece to everyone here.
I see. So to repeat one more time, the 0% promotion, right? You don't need to key in any promotion code. Just come to our, just visit our website, get more information before you do investments. Within the portfolios. So Jerry, I think a lot of people wanted to hear, especially from you, what is the minimum lump sum for this portfolio? How friendly it is, how accessible it is for all.
Yeah, I think the minimum investment is 1,000. So it's
as low as 1,000.
Yeah, it's actually affordable to everyone.
I see. Okay. I think so if that is the end of the webinar, then I will say thank you everyone one more time for joining us in this fireside chat. In the future, Definitely, this is not our only fireside chat. In the future, we will get Jerry and the rest of the team members to talk to you guys together. So hopefully, we'll be able to answer all of your questions and also inquiries. Whenever you feel like you want to ask Jerry more about the portfolios, just email us, just reach out to us so that we'll be able to answer all of your questions, all of your, so we can provide you more detailed answers one by one. Okay. So thank you all once again. Thank you, Jerry, for joining us in this fireside chat. Have a good evening. Stay safe, everyone. Thank you so much.
Thank you, everyone. Thank you. Bye.
Thank you.